Hey, this is Ryan Mallory with Stock Market Crash Update number 12. Is it even a crash at this point? Should we just completely dismiss this whole market and say business as usual? Go back to what you were doing, buy the dip. Fear not, the market's going straight back up. You got a stock market that's doing quite well off of the lows, and you got an economy in shambles. You got jobless claims at over 33 million. You have an unemployment number at 15% almost. This is like Great Depression kind of stuff, but the market doesn't care. It just keeps on rallying. We had 2 weeks of selling prior to this week, but guess what? We wiped out those 2 weeks here with the S&P 500 rallying 4 out of the last 5 days. You've got the Nasdaq up 5 straight days. The market's just buying in the face of huge headline risk of the fact that, yeah, we're reopening the economy, but we could easily go back to a shelter in place if we start to see the cases spike up again. Should we just assume that the stock market's going to look past that and keep on trucking? It could. I mean, it certainly could. But what I'm going to do in this video here is I'm going to go through the daily, I'm going to go through the weekly, the monthly charts of the S&P 500. We're going to go through some of the other indices, go through some of the real high-flying popular stocks like Shopify, Roku, Wayfair, some others. We'll get into that. Maybe we'll even do Boeing, and we'll get into the VIX as well. There's a lot of people scratching their head at this market rally. This is probably one of the most hated stock market rallies of all time. You still have a lot of people that are bearish on this market. I question the sustainability of this rally. I don't believe that there's the ability for it to go straight back to all-time highs without some kind of pullback in the near future. These dead cat bounces, they're really what they're intended to do is to make everything seem rosy again, to make everybody feel like the worst is behind us. And then that's when the rug pull happens. It hardly ever happens when we actually expect it to happen. It usually happens at a moment of its own choosing, but when it does, it's fast and it's ferocious. There's usually a catalyst behind it. It's been surprising because 5 out of the last 6 jobless claims, the market's rallied. You got 15% unemployment, or 14.7 to be exact. Market rallied like crazy yesterday. It couldn't care less. But that's what dead cat bounces do. It makes you think that it's no longer worried about the bad news, that it's priced in, that the market's going straight back up. And there's always the possibility that that's going to be the case. But I think where the skepticism for a lot of people like myself is that the lows from March 23rd would probably have been a little bit more acceptable had we not just gone straight back up in the face of everything that we're seeing. Because about 61% of the losses have been recovered by the stock market so far. And it has spent more time rallying off of the lows than it ever did going down, by about 50% more. So a lot of people are looking at the possibility of S&P 500 reaching 3,000 again as early as next week. It's about 71 points off of that level. That could be achieved in 2 to 3 days if the market took a bullish notion to doing it. Key support held up this week. You can see we gapped down on Monday. We were trying to continue the weakness that we saw towards the end of the week. It gapped down, tested the support level, and has been bouncing ever since. Now it's looking at taking at the dead cat bounce rally highs out at the beginning of next week, should the bullishness continue. And for the first time, you have a possible test of the 200-day moving average. So there's a lot of people that think that we could actually see 3,000 next week. It's about 71 points off. It's achievable. It could happen in 2 to 3 days if it took a notion to continue this bullish momentum like we have seen in the past week. However, there's a big obstacle ahead, and that's the 50-week moving average. I haven't talked about it in the past videos because it hasn't really been in play at this point, but it is now. 50-week moving average has been a great support level for the bull market. When it's in a raging bull market and has a temporary pullback, it tends to pull back to the 50-week moving average and then it bounces thereafter. Now, you take the resistance side of it. Well, when you have a major sell-off in the market tends to have these dead cat bounces that go up to the 50-week moving average, kisses it, and then completely falls apart. So that's what we could see here. So the current 50-week moving average is at 29.94. When next week rolls around, it'll probably be somewhere around 29.93, 29.92. If it touches that, yes, it's going to get really close to the 3,000 level, but if it touches it, you could see a major sell-off. Look, I'm no perma bear here, okay? I've told you from the beginning, I've been skeptical of this market. I was bullish on this market until it topped out. Once it topped out, it took me out of my long positions. I had some short positions in play. I made some money to the downside. I haven't been as active on this rally higher, and I'm not upset about it. I've just been skeptical of it. My main goal is risk management, manage the risk. I feel like that right now at this level, trying to get long on a whole bunch of new stocks, there's a lot of risk to that, guys. You don't want to be getting long on stocks here after the market has made such a drastic move over the last 6 weeks. This is a major move, and for a lot of people, they think that's normal, but it's not. This is the kind of behavior that you see in a dead cat bounce. What we've seen over the last 6 weeks hasn't surprised me from the standpoint of, hey, why is the market moving up so fast? Why is there so much bullishness to it? Well, that's what happens in a dead cat bounce. You get a lot of bullishness. You get a lot of people that are buying the dip. You get a lot of new traders for the first time thinking that they've hit the mother lode of stock prices by getting into some of these depressed trades in the oil industry and the airline industry and the cruise line industry. People are buying these things because they see it as cheap. They see it as their chance to get long on the stock market that has evaded them for over 11 years. And while their intentions may be pure, it doesn't mean that it's right. And so we're coming up on this 50-week moving average. I think it could be a huge player here this week or the week after. And let me show you why. Take a look at 2018, touched it numerous times. You take a look at just this past year, in June, we touched it. We broke down below it a little bit and then we rallied. You go back to late 2016, we tested it, we bounced. You go back to even before that in 2016, in the August-July time period, we tested it and we bounced. When you go back through history, you can see this red line is constantly being tested and the market bounces off of it. You can see here, 2014, 2013, 2012. We've bounced off of it almost every single time. Going back to 2018, we broke below the 50-week moving average, just like what we did here with the COVID virus. We broke below it and then we bounced right back up in a matter of a couple of weeks. This is what you saw back in the November rally. Bounces around it, consolidates, and then takes the next plunge lower. How about 2015 when we saw a major market reversal? We broke below the 50-week moving average, went right back up to it, consolidated, plunged lower, took out the previous lows before finally putting in a bottom and moving back higher. Now the sell-off in 2011 that broke the 50-week moving average, it was a little bit different. Broke below it, bounced, hit that 50-week moving average, consolidated some, sold off for another 2 weeks, almost went back to the previous lows, not quite though, and then finally had that bottom put in, but it actually put in a higher low. So that was a little bit different than what we had seen previously. But now how about the granddaddy of them all? Let's look at 2008. Major sell-off initially. We go right back up. This dead cat bounce lasted a couple months, went right back up to that 50-week moving average, tested it almost perfectly. And what did it do? The major fallout ensued. I'm showing you history here. Okay, I've showed you where when it holds, it tends to be a great loading point for stock purchases. But when it doesn't hold, don't expect it to go right back to new all-time highs right away. What tends to happen, you have the sell-off, and then you have the bounce back that goes right back up to the 50-week moving average, and then the next plunge lower. You can see that the 2008, yes, for those who lived through it, traded through it, it was a pretty drastic moment. But what we're dealing with is pretty drastic itself, if not worse. Employment's worse, earnings are going to be worse. There's no idea of how many companies are actually going to fold up shop. There's a lot of unknowns still, and the market's trying to act like it doesn't even exist, which is okay. That's what happens during dead cat bounces. But that's what the market's trying to do. It's trying to suck everybody in. It's trying to make the shorts panic into getting long to think, okay, I can't make money off of this, I'm getting out. It's trying to make the longs think, I need to go into margin because I want to make my returns even better than what they currently are. And then it pulls that rug, guys. The reason why I'm telling you this is because I don't want you to be part of that rug pull. I've said before, if I'm wrong on this stuff, man, look, it makes trading so much easier going forward because if the Fed can just print its way out of this whole mess, there's no need to ever short again. You just go cash or long. And I'm fine with that. Look, that's what, I don't agree with it, but if that's what the market's going to do, I'm going to adjust to it. But I'm just telling you right now, looking at the history, we have no reason to think that it's going to be different this time. And whenever you think that it is different, that's when the market burns you. Now, what about the monthly chart going back to 1974? I still think that there is a key moment here for the markets that if the 50-week moving average does offer resistance, we take out the lows from March, this is the next logical area for the market to pull back to, is this long-term monthly trend line. I think it's interesting to point out, just as a funny side note, that the S&P 500 has only been down this year when the economy was open. When the economy closed, the market went up. That's kind of weird, right? January, February, March, we went down. When the economy was completely shut down, April and May, it's gone up so far. Take the Nasdaq. This is the monthly chart of the Nasdaq. If the month of May was to close right now, it would be closing at new monthly all-time highs. That is crazy. Now the Nasdaq composite, it's also 1% positive on the year. However, it's broken its trend line back to last week and is trading on the underside of a broken trend line. How long can that go for? I'm not sure, but this is the one area of the market that is the brightest. This is where most of your money's piling in. When the market's rallying, it's usually because of the Nasdaq 100 rally. And if it's struggling, then they put the money in the small caps and energy stocks, and they get the market to rally that way. But by and large, the Nasdaq composite has been the market leader. Now take a look at the Etf the Russell 2000. It is actually holding up pretty well here so far. It's staying within a rising channel, has yet to break it. But if it breaks below this rising channel, I would start to look at places where you can start cutting some of your positions, start raising some cash, and wait it out to see where the market wants to go from there. Now look at the VIX. This thing continues to have a meltdown. Dropped another 11% on Friday, and it's below a key support level. Could we see this gap get filled here from February, that's a strong possibility. It is also synonymous with the gaps that we saw in the Nasdaq and the S&P 500 and the Russell during that same time period. Now let's look at some of your high-flying stocks here. You wanted me to look at some of them from the last week's video. I'm going to do that here. Shop, an incredible trend line off of the 2016 lows. It stretched to the upside. Guys, it's trading at all-time highs in a very concerning market here, a very concerning economy. Yes, it's doing great. It's the biggest company in Canada now, but is there a case where it can come back down to the 300 level and retest it? Yeah, that would retest the long-term trend line. Very possible if this market falls apart again. The reality of the market is it doesn't care what you think. It's going to do what it wants. And if the market does turn lower, it's going to take Shop with it. Short term, you have a consolidation out of a breakout here. That's a pretty nice look there. I like that. From a trading standpoint, looks pretty promising. Would I buy it at $712 a share? No. What I would wait for is for a pullback to the 662 level, try to get long from there, and then ride the trend higher in the short term. But I wouldn't make a long-term position out of it. Wayfair, this thing's up like 700-800% in the last few weeks since the March lows. Don't go chasing this stuff. I mean, you can chase it, and maybe you can make a few more bucks out of it, but I'm telling you, the smart money's going to be selling you their shares while they're getting out with some major profits. You got huge gaps to fill. You have it down at 160, you have it down at $60 itself. Those gaps tend to get filled over time. This is a dangerous stock to be playing with at this level. I would get out. I wouldn't even short it either because, guys, it could still keep going up because there's so much momentum for it. I just don't think that the risk reward is justified at these levels. Right now, if you're long on it, start cranking up that stop loss on. Don't let it drop below 160 if you got into it in double digits. Guys, book some gains, man. Roku's got a lot of resistance overhead. You got the trend line off of the November highs, that's playing into it. And then you have the trend line going off of the August highs of last year, that's playing into it as well. That caps the reward side of the trade without diminishing the risk at all. The risk is still high on this trade. It breaks below 110, it's gonna get really ugly really fast. Now how about Boeing? Guys, stay away from this thing. This thing is a disaster every time I trade it. I've tried to trade it over the years to the long side. Something always goes wrong when I try to trade this thing, but there's a perfectly good descending triangle pattern on this thing that if it breaks below, it's going to retest the double digits again. It's going to below 100. I don't like this chart at all. It has not even followed the market higher. It's still trending lower despite the market trending higher. Why would you want to get into a stock that's doing that? People are still clearly not wanting to get into this stock. Now let's look at SPCE, Virgin Galactic Holdings. It looks like it's setting up for a breakout here. You have a nice chart where it's attempting to push out. You also have a rising trend line that it's holding as well. But in this market, in this environment, I'm going to take a pass on stocks like this. This thing, it's very speculative, very risky. I would rather put my money somewhere where there's not as much risk to the downside if things get really bad again. So here's the main question I would like to ask you about everything we've talked about so far. Is this sell-off a one and done event? Is 15% unemployment a one and done event? Is 78,000 US deaths a one and done event? Is shut down economy a one and done event? Is things just going to pick right back up? Everybody's going to get hired again. Earnings are going to go back to normal. Spending habits will be normal. Business investment will be normal. Buybacks will be normal. Is all that going back to normal? Or could there be more to this market to the downside? Because if it keeps going up, then yeah, it is a one and done event. But through history and what I've tried to show you, yes, in a good market, you have these little blips that the market goes down and bounces right back up, but never to the degree of what we've seen. History shows that to the degree of what we've seen, this market sell off, that you always have a dead cat bounce. And then the market goes back down, takes out the lows, and creates new lows. The market wants to create the most amount of pain for the most amount of people at a given time. The biggest thing that the stock market can do right now is create mass selling because it's going to cause the most pain for the most amount of people. People are jumping back into the market right now because their fear is that they're missing out on a great bull market rally. They don't want to be left behind. I'm seeing it. I'm getting the emails. I'm getting the texts from family, friends, and from colleagues. They're worried, and that's just the time that the market wants to pull the rug out from underneath you. If you like this video, I'd encourage you to like and subscribe. I appreciate all the encouraging comments, even some of the negative comments. Tell me what you think about the stock market. Are you starting to get a little bit nervous about this market? Is it too much too soon? Is it one and done event? We just went down, we're going straight back up to all-time highs. Put it in the comments, tell me what you think. What did you think about the stocks that I talked about? What are some of your favorites as well? And I'll try to include them in the next video. Thank you and God bless.